Hello and welcome to the Mining Beacon webinar. My name is Andrew Thake from Mines and Money, and I'd like to welcome you to our webinar, which this week is on where are we in the battery metal space now. For this session, I am delighted to welcome an esteemed lineup of panelists. Firstly, we have Chris Berry, who is president of House Martin Partners. Just to briefly introduce Chris, Chris has been an independent analyst since 2009 with a focus on energy metals supply chain analysis. This includes lithium, cobalt, graphite, copper and vanadium. We're also joined by John Hykawy, who's president of Stormcrow Capital. John Hykawy has been in the industry for many years. He's an invited speaker internationally on topics such as lithium, the rare earth space, fluorspar, tin, and other categories. He's also a trained environmental physicist. Our third panelist is Jack Lifton, who is a co-founder of Technology Metals Research. He's also a consultant, author, and lecturer on the market fundamentals of technology metals. And last but by no means least, we'll also be joined by Carlos Vicens, CFO of NeoLithium Corporation. He has over 20 years of experience in financial analysis, corporate development, strategy and investment banking, including mergers, acquisition, and corporate finance. So a warm welcome to our four panelists. So I think that without sort of further ado, let's kind of go to our sort of like first set of questions, which on the where are we in the best opportunities for investing in battery metals now. I'd like to go and put the first question to John Hykawy. So where are we in the battery metal space now, John?
I jumped the gun on Chris at a conference a little while ago and stole Winston Churchill's quote. But without going through the entire thing, I think we've certainly reached the end of the beginning. Especially as pertains to battery metals used in automotive batteries. We certainly know the game with respect to consumer electronics and the like. We're trying to achieve higher and higher energy density. The same is probably true for battery electric vehicles, although obviously there's a much greater cost consideration there. And as a result, we're starting to rationalize better where our new battery chemistries can take us and what metals are going to be the metals that define the space in the years to come. Obviously, it's a technology game, Andrew. We're going to change things as we move forward. But right now, you know, we know enough to realize that where the bottlenecks are and what metals are going to be important in the next few years.
So turning to Chris, how significant a driver then are battery metals currently in this commodity cycle?
Well, you know, they're certainly, I would argue, more important than they've ever been, for a lot of the reasons that John had just mentioned. You know, I like to think that lithium and cobalt, for the last couple of years at least, have been the bells of the ball. You know, you've sort of seen copper and nickel and some other bulk commodities struggle from a pricing perspective, while lithium and cobalt and, you know, certainly vanadium last year really sort of took off, although they've come back down to earth a little bit. You know, with lithium demand in particular set to grow at around, let's just say 15% per year going forward. And, you know, this isn't just me coming up with this numbers. I mean, a lot of the major producers themselves are predicting that and talking about a demand scenario of 1 million tons a year of lithium carbonate equivalent by 2025. You know, it's clear to see why so many eyeballs are on the space and so many are interested. I do think, you know, while that the demand side is exciting, obviously, you know, the supply question kind of looms large over the market. And I actually think a bigger challenge at this point is just the funding, okay? How are we going to go from a lithium market, for example, 270,000 tons of demand last year to 1 million tons in 6 years, which is, you know, not that long when you think about mining cycles. You're going to need about probably, you know, $10 billion in capital to get to that number. When you look at the offtakes and the funding that have taken place just in the lithium space recently, most of it is coming from China and Chinese strategic players. And so I worry a little bit about, how deep the well is in China, so to speak, from a funding perspective, and also where else beyond China that kind of capital, the 10 billion plus, will come from. But, again, I do tend to believe that the demand numbers are right. Whether or not we end up at 800,000, 900,000, or a million tons by 2025, it's clear that, the funding pinch, I think, is going to kind of loom over this market going forward.
Mm-hmm. So, Jack, I know that you speak to many investors. When you're speaking to investors, what do they think about the battery metal space now? Are they as into the battery metal space as they might have been a few years ago?
Actually, the answer to that question is no. Chris hit on the real problem here. It's not just lithium. There's a huge amount of capital demand if we're going to meet these projections. And quite frankly, mining finance has not been booming in the last year or two. I'm just seeing a revival now. The problem is these are major figures. And I'll tell you something else. We keep talking about battery metals. We don't seem to be talking about what they go into. And so I'm based in Detroit, and I'm going to tell you that there's a lot more things involved in manufacturing an automobile than just the battery. And if we agree that we're going to electrify, so to speak, the personal and freight vehicle space, I'll tell you that the greatest overlooked problem, in my opinion, at this point, is rare earth metals. The demand there is going to skyrocket, and we're right this moment. There's a huge number of rare earth developments taking place outside of China, but they're not very well recognized by finance or organized. So I think that we have to have a holistic view here, and we're missing that.
Yeah. So kind of like just in terms of that, Jack, in terms of like rare earths, do you have any sort of projections or predictions as to what role in electric demand?
It's very easy. An electric car that's going to use rare earth permanent magnet motors, and for example, the Tesla, is going to require, let's say, 2.5 to 5 kilograms of neodymium iron boron permanent magnets. Today, the average vehicle manufactured in this world uses 0.5 kilo of rare earth permanent magnets. But an electric vehicle using a rare earth permanent magnet drive motor is going to require 10 times that amount. And so we don't know what types of motors the manufacturers are going to use. We do know that it doesn't matter about that if you look at the various small electric motors and sensors on a vehicle. And again, it's been calculated. There was a study done at MIT that the average vehicle in this world uses 0.5 kilo of rare earth permanent magnets. There are 1.2, 1.3 billion vehicles on the road in this world. Added up, this metal is now, I don't know, frozen in place. It is not recycled from automobiles at this time. And so we need new production to replace it. That, of course, is in the purview of our Chinese friends. And we don't know what they're going to do about that, as they're the largest manufacturers and users of batteries for electric vehicles, which means they're going to be making more electric vehicles than anybody else, using more rare earth permanent magnets than anybody else. What happens when they get to the point where they don't have enough to export? What do? And quite frankly, you may think that's never going to happen, but I could tell you in the last 12 months, China imported 40% of the rare earth raw materials it's using. Something is changing dramatically, and we need to look at this.
So let's start to look at a few more of these battery metals in a little bit more detail. I'd firstly like to look at lithium in a little bit more detail, and I think probably ask a question to Carlos. Carlos, so is the bull market for lithium over?
Obviously, no. I don't think so. In fact, it has just started. I mean, I don't think we've seen what the bull market for lithium is, to tell you the truth. I mean, we did have a little bit of a blip, I don't know, a year and a half to 2 years ago, where you saw I would say some of the developers and explorers have a very successful, equity run. But as every single equity run there is, you're going to have some blimps or some bips around where that final price would be, which will, at the end of the day, helps you finance. Now, what we've seen lately, for example, at least us, is that we've seen a lot more interest from the strategics or the players within the market in trying to help finance some of the projects that they believe are going to be the next ones to be producing. So no, I would say that the run on the lithium stocks and developers and explorers is just beginning. Like everybody has said, we still need a lot more financing. And when some of these projects start to get financing, you're going to see a renewed interest within that sector.
So how does a up-and-coming lithium player, such as yourself, Carlos, compete with larger, more established players?
Well, I mean, look, what we've tried to do is keep our head down and focus on what we're trying to do. I mean, we're not trying to do more than we need to. We obviously try to hire the right people and focus on our project. We're not trying to do too much, outside of what our project is. Obviously, every project in the lithium brine sector is going to be different, and that, one of the things that I'm not sure I logged in a little bit late because I'm in China right now, but I had some issues connecting. But I'm not sure if somebody mentioned that I never seen an industry where there's so much I would say like an unknown or about the supply side of the industry. A lot of people, the so-called experts, always talk about the demand side and how much the demand's going to grow 3, 4, 5 times, but there's very few people within the industry that really know about the supply side. And the brine is a very complicated type of I would say, project within the lithium space. I mean, every single brine is going to be different. Essentially, it's a chemical company. It's not a mining company. So there's a lot of unknowns, and that, to tell you the truth, doesn't help the industry and doesn't help the investor base be confident in where to invest, because they see all projects as equal, and it's not necessarily the truth. So what we try to do as a up and coming, or as the next developer, or as a potential future producer, is to provide the investor base with as much information as possible, be clear and concise with the information that we provide, and totally de-risk the project as we go forward. And that's essentially what we've been trying to do for the last 3 years.
We've just been sent in our first question by one of our listeners. So, question on lithium brine technology: will it go and change the landscape for lithium production, and if so, how?
I guess that's a pretty wide open question, Andrew, because it's, there's a number of technologies that are out there and are being developed. Certainly the industry is ripe for some of the technologies that are out there. I mean, I can speak to what POSCO has done in the space. Their technology has essentially enabled a much higher recovery of lithium from a given amount of brine. It's also enabled a much lower cost production of lithium, providing you have access to relatively inexpensive electricity and a few reagents along the way. Those things are net very, very positive for the industry, because one of the things that I think we sort of touched on is if we can't produce a material and we can't guarantee the availability of that material, the automobile manufacturers in particular are not going to rely on it. I mean, they need to know that they can get these materials. They're not going to design fleets of vehicles that they could sell in theory, only to find that the materials are unavailable to build them. Similarly, I think sometimes people forget that the automotive industry is not military aerospace. They're not out there trying to do cutting edge stuff at any cost. They're out there trying to build an acceptable product for the least amount of money that they can put into it. And that tends to mean cheap raw materials and lots of them. So if we can move towards that part of the, that part of the curve, I think we're doing the industry a service.
Can I make a comment here? You couldn't be more correct. The automotive industry locks in a production schedule up to 3 years ahead of time. Now, if you tell me I don't know if I can supply you the battery because I don't know if I can get the lithium, that means they're not going to do that because they can't afford it. So this is one of the biggest overlooked issues is exactly what was just said. This is not aerospace we're looking at. This is automotive, which is, hammer and tongs, basic manufacturing industry. They need to know what things are going to cost in the near term. Near term means 3 to 6 years. So this is a very big, finance is probably the biggest issue today in battery materials.
Agreed.
It's really, you gotta de-risk this. And automotive is not de-risking it for you. They're telling you what they require.
That's kind of some interesting comments and feedback there. Let's move on to the topic of lithium recycling. I was speaking to you about this, Chris, a couple of weeks ago. Should investors be looking at investing into lithium recycling as opposed to just looking at investing into lithium mining companies?
Well, I certainly think looking at opportunities along the lithium-ion supply chain helps you diversify and spread risk. If you're sort of just focused 100% on the upstream portion of the supply chain, you kind of live and die by the trajectory of lithium pricing, as many people in the space found out in 2018. And so, when I think about lithium-ion battery recycling, look, this is technology that's not new. It has been done for quite a long time, actually, and there are a number of different ways to do it. The technology does continue to improve, and I think there's a little bit more of a focus on it now than ever before. Again, when you think about everything that we've just sort of talked about at this point, which is of course getting to 1 million tons of supply by 2025, or reckoning with, if you take a look at, for example, what Benchmark Mineral Intelligence is talking about with, whatever the number is at this point, 1.5 terawatt hours of battery capacity by 2028. Governments, globally, I think are looking at these statistics, and they're also looking at OEMs and saying, hey guys, at the end of life of these batteries, they're your problem. Okay, they're not going to go in a landfill, and they're not going to go and sit in some, shed somewhere and just sit there. So, I think just generally speaking, from an investor perspective, there's not a lot of awareness around lithium recycling, and that I think has everything to do with the fact that, look at lower lithium, lower cobalt, lower metals prices, the economics really weren't particularly compelling. Okay, and so I think a view on recycling and what technology works going forward depends on your views on the pricing of these materials going forward. But there are a number of different ways to make money. It's not just recycling. You can reuse, you can repair and refurbish the batteries as well. That is a business that there are a number of recyclers all over the world, not just in China, take part in. And I think, again, as an investor, if you're looking at recycling and what the real challenges are in terms of building a sustainable business, it's all about security of supply. Okay, and it's not security supply of the actual commodity, it's security supply of batteries. And so, I think it's a really interesting space. That is kind of the big bottleneck at this point in time. And also just sort of thinking about, okay, well, you've got all of these different chemistries and different sort of end uses. How do we sort? How do we shred? And ultimately, how do you recycle profitably? So it's kind of a long-winded answer, but I do think that recycling is going to become, I don't want to call it the next big thing, but it's going to become a lot more important just from the standpoint of the fact that there are going to be a lot more batteries sloshing around out there over the next, say, 8 to 10 to 12 years, and we need to figure out how we're going to deal with them.
Okay. We have another question that's been sent in by one of our callers, George Hallis. George asks, do you think hydroxide should be produced via brine carbonate in the future, or should hydroxide come from hard rock? Would any of our panelists care to take a stab at answering that?
Well, I can jump in on that topic first, I guess, Andrew, and I would say the answer to that is definitively not from carbonate. I mean, the carbonate route is likely one of the more expensive ways that we could produce hydroxide, but it was what was available to us at the time. Both POSCO and Nemaska Lithium in Canada have more direct routes, either from hard rock or from brine, to achieve hydroxide, and not coincidentally, they're also much less expensive routes to producing battery grade hydroxide than the incumbent path. So again, I'd say lower costs are a good thing. Certainly, being able to produce the material at a lower cost and more reliably than has been done in the past is probably going to be very positive for the industry. But it's not the either or that was described. It's not either hard rock or brine going through carbonate. There are direct approaches available now.
And you need to keep something in mind here. Nemaska, for example, is now faced with a higher cost than they originally predicted. We don't exactly know why. Now, the problem I see is this: it's in all manufacturing. Let's say, as was just said, we have a new technology for producing hydroxide directly. We have to decide that's what we're going to do, lock it in, build the plant, start producing. We're in the situation where we've been so many times. Everybody's talking about, I've got this technology, that technology. That's all wonderful, but I have a date I have to be producing by. I have to pick something. And I completely agree that there's a lot of changes here, and making lithium hydroxide is not the easiest thing in the world, certainly. And these companies are now facing reality. They have to decide what they're going to produce and how they're going to do it. And that's what I'm watching. Let's say that we don't know how to differentiate some of these companies, but downstream is where I'm looking. What are they going to produce, and how much is that going to cost? And forget about all the different great new technologies. As someone said before, this is not aerospace. This is nuts and bolts. And when I first looked at this space, and it wasn't that many years ago, there were 16,000 tons of lithium produced, considered as metal. That was 100,000 ton carbonate. SQM, which I represented for a while in the United States, was producing 50% of the world's lithium 10 years ago. Look how that's changed. It's very difficult to pick winners and losers right now, but I can tell you what, look at the downstream part of what they're going to do. And I think they all want hydroxide. That's what I'm seeing. If somebody else here has got a different view, please tell me. But people want hydroxide, and it is not the easiest thing to make in quantity.
I can add to that. I mean, in terms of new developers and what they're asking us, let's put it this way: they're not asking only for hydroxide. The carbonate market is bigger than the hydroxide market today. And in Australia, obviously, most of the hard rock guys and all the spodumene con that goes to China gets produced into hydroxide. So that market essentially, I would say, is mostly done in terms of it's going to be hard for a new developer now from the brine side to compete in the short term with that type of price. So they're asking for carbonate. So there's significant potential for the carbonate producers or the brine producers just to produce carbonate. They're not asking only for hydroxide. In fact, they're asking us for carbonate because they don't have enough carbonate to go forward. It's going to be a very, very big market of carbonate. In fact, I believe the carbonate market will be much bigger than the hydroxide market for the next 8 to 10 years. Now, the hydroxide market is growing faster. Yes, it is. It is growing faster. But the carbonate market is a much larger one, and there's going to be significant growth within that market. And another thing that I wanted to add is I agree with John that in terms of the ease of going from the hard rock to hydroxide instead of the carbonate route. However, some of the brine developers and some of the brine producers are able to potentially compete. Not all, but some are potentially able to compete with the hydroxide producers today. And I believe that some of those guys that have that capability will do so later on. Now they're going to be able to adjust their production scenario as needed in terms of where that demand is going future and where that potential discrepancy of pricing is between hydroxide and carbonate. So you're going to see if the hydroxide premium to carbonate tries to be is too low, then they'll use carbonate because they might see that the margins are going to be better on the carbonate. So that's going to also play a factor.
That kind of leads into the next question sent in by one of our listeners. Are there any other advantages or disadvantages of rock versus brine lithium projects? Perhaps I can ask you, Carlos, to go and answer that.
Well, look, I mean, at the beginning, when I came in to work with Neo 3 years ago, I remember the Hardrock developers, explorers, and some of the producers were essentially selling Hardrock as the cheaper way to go on a capex intensity level, and the way they were looking at this was that they were essentially transforming or going from the concentrate, the spodumene con, to a lithium carbonate equivalent, which is not necessarily the final product, right? Well, not necessarily, no, it is not the final product. So you can't compare an intermediate product with a final product in terms of capital intensity. So that comparison today is not correct. I mean, we obviously seen that the capital intensity for some of these hard rock projects is very high, i.e. some of the capex overruns with Nemaska, and some of the overruns also in Australia. So the capital intensity is competitive between the brines and the hard rock projects. Now, then on the OpEx, when you compare them, you're going to see that it is now becoming comparable in terms of hydroxide, but is not in terms of the carbonate. So OpEx is also difference between what type of end product you're going to produce. The only thing that I would say that is beneficial on the hard rock guys is that hard rock guys are a bit more easier to predict in terms of production. You're not essentially have a concern about weather patterns and other things. You can be able to get to market a bit faster in terms of the way the evaporation rates and so forth. But beyond that, I believe the capital intensity is the same. OpEx in terms of what you're producing is a bit better for the lithium brine players instead of the hard rock guys on the carbonate side, competitive on the hydroxide side. And in terms of operations, the ease of operations on the upstream, on the mining side, seems to be a little bit better for the hard rock guys, at least for now.
Okay, thank you very much for that answer. We're now going to go to our online polls, which we invite all listeners to participate in. The first poll is which battery metals are you the most bullish about? So if listeners would like to go and vote now, and then what we'll do is we'll go and show the poll results at the end of today's webinar. And then the second poll that we'll also be doing as well is which battery metals are you the least bullish about? Okay. Whilst sort of like listeners are voting, we've just had like another question that has been sent in that I'd like to go and turn to, which is on the subject of graphite. So, can the panel talk to the future availability of finished flake graphite products for battery anodes, both from the upstream resource perspective as well as from the downstream coated spherical graphite perspective? Would one of our panelists care to take that?
Yeah, I mean, this is Chris. I can start off with it. I mean, I think just very generally speaking, you know, the anode players that I've spoken with are really looking at a future where, yes, you know, they know that the natural graphite that is sourced is cheaper, quite frankly, relative to synthetic, but they're looking at a future where the anode they're going to be using is blended, and that has everything to do with the diversification of risk, and also the fact that, you know, we sort of alluded to this on the lithium side, but it can take 12 to 18 months for a new producer to qualify their product with an end user. So, you know, I don't have the actual numbers in front of me as sort of where we are in 2025 or 2028, but, you know, it's kind of a situation, I think, where the end users, the anode producers are going to be looking at a future where, you know, maybe they're not, I don't know if they'll be happy to use both synthetic and natural graphite, but that's probably the future they're going to be faced with. And of course, you know, China looms large here as well, with 70% of the overall production and mine closures there. So it's a little bit of a mixed bag. But again, you know, if you just sort of go back and look at those potential battery factory demand numbers that I referenced before, you're going to need a lot more of it. And so it's going to be a future where I think a number of different sources of graphite are going to have to be used to make it work.
So, going back to sort of battery metals and which one provides the best investment opportunity. Jack, out of all the battery metals, and I'm also going to include rare earths into this as well, given in mind your earlier answer. Out of all the battery metals, lithium, cobalt, graphite, nickel, rare earths, vanadium, which commodity are you most keen on as an investment opportunity, and why?
I actually am still bullish on cobalt, because I think that at the end of the day, there cannot be enough with present sources, all of them put together that we know. There's no way to meet the projections I've seen from major companies like UBS, for example, and Morgan Stanley. They all have these projections of hundreds of thousands of tons of demand in, let's say, the mid 2020s. I have no idea where anything like that would ever come from, and so I think there's a lot more to be said about cobalt. And quite frankly, I'm very intrigued by the dramatic uptake in interest in extracting cobalt from nodules on the sea bottom. Now, I used to think that was crazy also, but it's not. And there's quite a bit of money going into it right now, and quite a few active projects. And I don't know on the land where there's going to be any more cobalt coming. Yes, there are 10 or 20 juniors, but none of them is going to produce more than 1,000 or 2,000 ton a year. So what? And the worst thing of all is that co-produced cobalt, such as from the Congo, is dependent on the major metal being mined, being produced. And we know how volatile those markets are. So the cobalt market is quite volatile. And what's depressing the price right now is not that, oh, well, there's going to be enough of it, but the fact is that the electrification movement has slowed down. That's what's going on. And so I think that cobalt has a bright future as an investment metal. To be honest, I wouldn't know where it's going to come from.
And
I'm going to agree with, if I can, Andrew, I'm going to agree with Jack. I'm going to add one point, which is cobalt has a number of end uses, as does lithium, as do any of the battery metals. But the problem with cobalt is the other uses are mostly high value. You're talking about a sintering agent that's used to make hard metal, a cutting material when it's combined with tungsten carbide for the steel industry. If you can't get cobalt to make that hard metal, your steel mill is going to necessarily lose a lot of throughput. That's extremely expensive. That's a high value use. You're also talking about the so-called super alloys, the high temperature alloys that are used to build things like hot boxes for jet turbines. Again, if you can't get your super alloy that contains cobalt, you can't make a jet turbine. That's a high value product. You're willing to pay up. So the problem in this space is the price could run away. Now, that said, I don't think that's going to happen for a while. But if I had to pick between all of the metals that you put up there, Andrew, my pick would be cobalt as well.
So just a quick sort of follow-up to that. Are there any cobalt mining companies out there that any of the panelists would recommend our viewers to invest in? And if so, which ones?
I'd like to jump in and say absolutely, and here they are, but Jack raised a really important point as well, which is cobalt is largely, especially in large quantity, a byproduct of either nickel or copper production. In order to open a big new mine, you tend to have to find a market somewhere for an awful lot of nickel or copper. That isn't necessarily something that can happen. The junior cobalt producers are somewhat trapped at this point in a market with lower cobalt prices and diminished expectations and an inability to find funding to carry their project forward. So to tell anybody to go running in front of that train, I think would be imprudent, to say the least. There are some good projects out there, but obviously you're going to have to do your homework, and you're going to have to depend on future financing to see those projects carried to completion.
Okay. We've had another question sent in by one of our listeners, Walter Winnig. Could one of the panelists, or could the panelists please comment on the expected growth rate between lithium carbonate and lithium hydroxide?
Yeah, I can take a stab at that. I think the consensus right now, again, if you look out over the next 7 to 10 years, is that given the fact that the carbonate market has such a head start, in other words, it's just a much larger market relative to hydroxide today, in 7 to 10 years, it will probably still be at least slightly larger than the hydroxide market. My own view is that it's, maybe not quite a 50-50 split in the next 7 to 10 years. I think the carbonate market will be just maybe a little bit larger, but the growth is really going to come in the hydroxide space. And, we talked about this earlier, so I won't rehash everything, but I do think one of the things that you want to keep a very close eye on as you're trying to understand the supply chain and how it grows and trying to figure out what product a mining company is going to make is to take a really close look at conversion capacity and conversion capacity growth. That's always sort of been a black box along the supply chain because so much of it is in China. We're just on the verge of Albemarle and Tianqi, I guess, getting ready to open up 48,000 tons of hydroxide capacity at Kwinana. Of course, Albemarle just put shovels in the ground at Kemerton in Western Australia. That's up to, I'm not saying it's going there, but it's up to 100,000 tons of hydroxide capacity. Of course, Nemaska, we talked about earlier. And then various, additions in China as well. So, again, a little bit of a long-winded answer, but I think that, if we're having this conversation in 7 to 10 years, carbonate is not the monster that it is in this market right now. It's probably closer to a 50-50 split, but the growth is definitely coming from the hydroxide side.
Okay. Thank you very much for that, Chris, and hopefully that answers your question, Walter. we're now going to switch gears and move on to vanadium, which was, of course, the best performing commodity of 2018. So perhaps my first question is to John Hykawy. Vanadium was the best performing commodity of 2018. Why?
Andrew, and I'm still kind of puzzled by the classification of vanadium as a battery metal sometimes. I mean, yes, there's absolutely, as one of the people who sort of brought this to the market's attention many years ago, vanadium is obviously useful in flow batteries and vanadium redox batteries, and vanadium redox batteries certainly have potential to be addressing bulk energy storage, especially as we think of the problem attached to renewables. But there's very little of that happening. So what really drove the vanadium pricing over the last couple of years was the closure of one major production point, one major mine, as well more recently as the change in rebar classification and strength in the Chinese market. So requiring much stronger reinforcing bar for construction projects in China has led to a significant upheaval in that market, a slight shortage in supply coupled with people panicking and trying to put in stocks to make sure that they weren't caught short. And that drove the price up. It didn't have anything to do with batteries. It was strictly steel that was driving that, as it will for an extended period of time. The biggest problem with vanadium redox batteries, unfortunately, is that they're still quite expensive, and high vanadium prices certainly wouldn't help drive those costs down. So, you know, it's a bit of a chicken and egg problem. If we get the storage and vanadium redox batteries sucking up a substantial amount of vanadium production, we're probably going to drive the price high enough that it's going to be difficult for those same batteries to compete on a cost basis. You know, but it's down to changes in the steel industry that have driven the recent price fluctuations. It's not batteries.
So, given that in mind, Chris, what do you think is in store for vanadium for 2019?
Yeah, I mean, I would sort of echo John's comments. Actually, it's funny, one of the first reports that I ever read was something that, John, you wrote in about 2012. And, you know, even back then, China was talking about, you know, this sort of top-down edict where, okay, you know what, in 6 months, all rebar that's going to be used in China will have to be fortified with vanadium. And that was 2012. And it was sort of like, I started to look at this like the boy who cried wolf, because it was just around the corner from happening. And for whatever reason, that you know, law, I guess if you want to call it that, was never really, at least identifiably, put into place. And so, of course, fast forward to, you know, last year, where yes, it was announced, it was press released, it happened, and coupled with, you know, just historically low vanadium prices, you had mine closures and a really tight market, and that exploded the price higher. Of course, for any of you on the call that have looked at a vanadium price chart recently, whether or not it's V2O5 or ferrovanadium, we're sort of maybe slightly above where we started this boom. So, you know, the parabolic moves in the vanadium market have kept a lot of people out, quite frankly. You know, that said, I could certainly see a vanadium market or a vanadium pricing market where pricing, say, for vanadium pentoxide settles at a, let's just say, a new normal, sort of maybe $16, $17, $18 a pound, something like that, higher than it's been historically. And again, this has everything to do with these new laws in China finally being enforced, coupled with the fact that, you know, there really aren't that many, let's just say, profitable at existing prices vanadium producers out there. So, you know, when I think about vanadium demand, I really, again, as John had mentioned, I look at the steel market and try and get a sense for what's going on from a global growth perspective. So, you know, my sense is vanadium could probably, on the demand side, you know, go forward at a 4 to 5% per year demand growth rate. Again, that's not as, you know, sexy as lithium or whatever, but it's still it's still pretty solid for what is a small market that is really dependent on steel. And then again, I do agree with John's sentiments. You know, vanadium redox batteries. You know, I think I'm not a battery chemist, but those that are tell me that technology is really optimal for grid scale storage. In other words, better than lithium ion. But lithium ion is a 30-year track record of safety, and quite frankly is viewed as good enough. And so it's just going to take some time, I think, for that mindset to sort of change in the vanadium space and VRBs to really take hold longer term. So, you know, optimistic about vanadium, but it's really tied to the steel market more than anything else.
Thank you very much for that, Chris. We're now going to move on to discussing electric vehicles and specifically how battery metals links up to electric vehicles and electric vehicles demand. When I talk to people, the most common statistic bandied around is that 30% of vehicles will be electric vehicles by 2030. Turning to Carlos Vicens first, what's your view?
Look, I mean, I look at it on a binary basis. I believe that once you hit a critical percentage, which, you know, it's hard to know where that critical percentage is. It's going to be, everybody's going to be on electrical vehicles. I mean, it's either going to hit or it doesn't. There's no in between. I don't believe that long term you're going to see, oh, there's 25% electrical vehicles in the market, and that's the way it's going to go. I believe it's going to be, you know, a significant more than 30 long. When I say long term, we're talking about way beyond 2030. So, you know, it's a best guess to understand and to know what, you know, if it's going to be 10%, 12%, 50%, 20% by 2027 or 2028 in 10 years. I look at it significantly a lot more than that in terms of long-term potential. So it's going to depend on, as everybody has been talking about, how much supply of the raw materials are going to be by those specific times and the financing on some of these projects to make that happen. Because at the end of the day, if there's no raw materials, unfortunately, this industry or the electrical vehicle industry is not going to hit that 30%. As simple as that. Now, you know, there's time to get there. But that's the logical view that I see. But if there is, if we for a moment say there is, you know, an unlimited or at least a sufficient amount of supply of raw materials available for the battery materials to provide to electrical vehicles, I believe it's going to be significant more than 30% long term. It's going to be, you know, a lot more than that by 2040, 2035, because at that point, the tipping point has happened. And when you go to buy a car and you see the same car as an ICE or electrical vehicle, and it's the same price, well, there's absolutely no question that you're going to select the electrical vehicle. So, you know, I don't see this as a gray. I see it as a black and white, and I'm more on the side that it's going to be significant more than 30%.
Would any of our other panelists share a different view?
Yes. The number of electric vehicles, when I say electric vehicles, I'm talking battery-powered vehicles. The number of those sold is going to be entirely dependent on the market, on if people want to buy them or not. So far, this has not happened in the United States, which is the market I'm most concerned about. North America has about 500 million people. That's Mexico, Canada, the United States. The sale of EVs in this market is quite small. When people talk about, oh, the increase, of course, when you go from nothing, if you sold one last year and two this year, that's 100% increase. Well, that's exactly the way this is being talked about. But in fact, what's the biggest selling vehicle in the United States? It's a pickup truck. Okay, and the next biggest vehicle is a so-called SUV, another huge vehicle powered by internal combustion engine. American people do not seem to be interested in this. This is the quandary for the American automotive manufacturing market. They don't know what to do. because if people don't want them, they sure as hell don't want to build things where each unit ties up tens of thousands of dollars of capital and it's not going anywhere. So what I see is a very slow introduction here in North America. And of course, China is today the major market, and Europe is going to be another major market because Europeans are going at this much faster than we are. But how many anode graphite manufacturers are there in the United States? Answer, none. Can you hear me?
Yep.
Yeah, Jack.
Okay. How many cathode manufacturers are in the United States? None. All right. So whatever happens, nobody in the United States is going to risk building the infrastructure and the supply chain if there's no market. And that's what I'm saying is, no matter what you read about from Washington, D.C., in the let's say the marketing areas of the car companies, they don't know what to do because the public is not excited about this product, and so that's a big problem. I'm not saying it won't happen. I'm just saying it's going to be slow.
If I can just add one comment to what you've said, I mean, it's important for us to remember something. And Jack, you with your connection to the auto industry, you probably have a much more vivid recollection of this than I do. But one of the things to bear in mind is that battery electric vehicles in particular were not a market-driven solution. Nobody confronted, a bunch of sign-waving demonstrators in front of General Motors headquarters screaming that they wanted battery electric vehicles. This was the answer to a piece of legislation essentially passed in California and then propagated out through all the other states in the United States that followed the California Air Resource Board recommendations, which was they needed a zero emission vehicle. And the car companies looked at that problem and said, well, there's only two ways to do it. One is fuel cells, one is batteries. Fuel cells, we're going to require about 3 Nobel Prizes to be won before we can do that successfully. So batteries it is, I guess. And then they started putting this together. But this was not a groundswell of consumer enthusiasm. This was an edict that was passed down and has been subsidized by government. There are always early adopters in the space. The question is whether we're going to see a mass market developing for this. And the answer, as Jack said so far, is unfortunately no. Now, that doesn't mean that the whole movement is dead. There are ways to build, in particular, hybrids that are probably less expensive than an internal combustion vehicle alone. But they're not the sorts of designs that we've seen largely to date. And this is why we're sort of closer to the end of the beginning of the electric vehicle movement than anywhere close to the end.
I agree 100%. The ideal vehicle from the point of view of efficiency is a hybrid. And quite frankly, Toyota's they've sold 1 million Priuses in Japan and 1 million in North America. So that's been a great car. I just want to add one thing here that we talked about recycling ways back. Let me remind everyone, what is the length of time your battery on a Tesla is guaranteed for? The answer is 8 years. We're way too early in the battery cycle to think about economical recycling. This is something for the end of the 2020s in North America. It's already occurring in China, but they've been at this a lot longer than we have. And one other comment, the most common battery for a vehicle in China is lithium iron phosphate. You can't recycle those economically because all you get is lithium of value. So we're a long way from knowing what to do in recycling anywhere in the world. And I don't even think we should even talk about it. And as I think Chris said earlier, the chemistry is not complicated. We've known how to do this forever. That's not the issue. There isn't enough material to recycle. That's the problem.
we just had another question that's been sent in by one of our listeners. Something else that was said to be a few years away, a couple of years ago, was solid-state batteries. Are they still a few years away from being a commercial reality? John Hykawy, what do you think?
I guess we'll find out in a couple of years, because a few companies have threatened to commercialize them, and if it happens, then we're there. And I would say one of the more interesting potentials with solid state batteries is the possibility of solving, or at least providing, a partial solution to some of our critical materials questions. The reason I say that is, for those who don't know, a solid state battery essentially replaces the liquid electrolyte. A battery is a sandwich. It's a cathode and anode, however you want to name those two things, because they kind of flip over in terminology, whether you're charging or discharging. But there's two electrodes in a battery with some chemicals on the surface, and then in between them is an electrolyte, a material that electrically isolates the two electrodes so you don't get a short circuit, but allows the exchange of lithium ions in a lithium-ion battery to enable charge and discharge. What happens in a solid state battery, with sort of a lack of imagination in the naming, is you're replacing that liquid electrolyte with a solid electrolyte. It can be much thinner and provide a lot more structure and stability to the battery. By being thinner, it raises the effective energy density of the cells that are constructed. Energy density is a big deal for batteries in your cell phone, in your tablet, but also in an automobile, because you want to be able to carry as much electricity as possible. So a lot of people have said, well, a solid state battery in a car, that means that instead of driving 500 kilometers or 300 miles between recharges, I could now drive 1,000 or 1,500 kilometers, maybe as much as 900 miles before I have to recharge. That's still a pretty big and very expensive battery as a result, for something that probably no one is ever going to do. I mean, who wants to drive 900 miles in any reasonable stretch of time without stopping? So what does come to mind, though, is the possibility that you could take a less energy dense material, but have an effective energy density in the battery that still allows you to drive a reasonable distance. Jack mentioned earlier, the most common automotive chemistry in China is lithium iron phosphate. It's very safe, it's very stable, it's also really, really cheap compared to some of the high nickel, higher cobalt constructions and chemicals that we use. Wouldn't it be nice if we could end up using solid state batteries that were equipped with lithium iron phosphate, and we didn't have to worry about our nickel and cobalt demand for the mainstream? Now, I'm not saying nickel and cobalt demand go away. Okay, John didn't say that. I have to keep jumping in with that. There's always going to be specialty usages where you want the smallest, lightest, most energy dense battery. And certainly you're going to want that in your cell phone, in a tablet, in a laptop. But for the mainstream market of automobiles, where people don't really care about the exact, size and weight or chemistry, maybe this takes some of the edge off, if and only if we get solid state batteries successfully commercializing.
Thank you very much for that, John. I think that as we're drawing towards the end of our webinar, I'd now like to bring up the results of the two polls that we had earlier. So if you recall, the first poll we had was, which battery metals are you the most bullish about? So perhaps if we can just get the results up. Lithium came up in first place, followed by cobalt, then copper and graphite, with vanadium bringing up the rear. I know that I asked Carlos early on in the webinar as to which commodity he was most sort of bullish about, so which battery metal he was most bullish about. Maybe I could ask the same question to John, Jack, and Chris. Which sort of like commodities are they the most bullish about, and are they kind of surprised by the results of the poll?
I'm really not surprised by. I guess maybe I thought copper would be a little more popular, to be honest with you, but I'm not terribly surprised by the results of the poll. I mean, if you think about this webinar that we just conducted, I mean, I'll bet we spent 75% of the time talking about lithium or something lithium related. So, you know, it's the one that I think is the least prone to substitution, and for that reason, I think that's one of the reasons why at least people got the most bullish on it. You know, look, I'd have to agree. I think part of the answer to the question about, you know, what are you bullish on has a lot to do with your time frame. And again, to sort of go back to what John talked about being at the end of the beginning, I think that, you know, any investors looking at this battery metals theme, you know, this isn't a 1 year, 6 month trade anymore. Okay, this is, if you're looking at this and thinking about how do I position myself or build a portfolio, you're going to be thinking 3 to 5+ years out. And of course, most investors don't do that. So it does take a little bit of a shift, I think, in perception and patience. But, you know, I do think that certainly over the next few years, cobalt is at or near the top of the list. And I actually think, just from the standpoint of, you know, building out the infrastructure, which is a whole other aspect to this whole theme, the charging infrastructure, I think that copper is particularly interesting going forward as well.
Perhaps I could just say, I actually asked us a question to Carlos. If people are investing into a lithium company such as yours, what sort of timeline do you advise them to have?
Forever, I suppose. No. Look, I mean, let me give you an example. A month ago, we were trading at in the mid 50 cents to close to 60 cents. A couple days ago, we closed at $1.10. That's 100% return in less than a month. And we've been as high as $2 and something, and as low as 55 cents. So, okay, it's hard to tell everybody when to buy, when to sell. What you need to do, and you know, I guess this is preaching to the choir, is do your homework on each of these assets. I mean, understand the asset itself. In terms of brine, understand the grade, the size, the impurity factor, where they are, what they're doing, how much money they've raised, how much money they put back into the project, who's involved within it. Have you read the presentations, the news releases? Have they, you know, those are the things that I would tend to tell people to look at. And then, you know, put the money in and do your homework, put the money in those companies and let it go. Because if you're in the exploration stage, you're going to have, you know, at this time of the development cycle, it's going to be very hard for you to find a new exploration stage that is going to be, you know, very successful. There's quite a bit out there now. So you're going to have to find the guys that are in the development stage that have been able to do what they told the market they're going to do, and they're close to being financed, and in order to de-risk that valuation to that next level. So you know, I believe that you can't just hold this. You can't be day trading on these stocks, even though you could, like I just mentioned, in a month you're making 100%. But it's going to be very hard, and you know, usually when I do that, I lose all my money. So I would rather tell people this is a long-term scenario, and you know, you're looking at a 2-3 year time frame to get a significant return on your money.
Okay. And then perhaps I can just ask to bring up the results of our second poll, which was about which battery metals are you the least bullish about. Perhaps we can bring up our poll results. And vanadium is in first place, followed by graphite. Do any of our panelists have any comments to make on the results? Any surprises there?
I'm not. I mean, nickel's not on here. I know it sort of goes hand in hand with cobalt and copper, but I'm a little concerned about nickel. I think that it's getting a lot of buzz because they're talking about, moving to NMC 811 eventually, or wherever we ultimately end up. And I think a lot of people are overlooking the fact that, a new nickel mine is going to cost about $1 billion in capex. And I know there are nuances and the whole class 1 versus class 2 argument, but I think that, I think that the market's a little too optimistic on nickel at this point in time.
It's kind of like interesting. I mean, I just sort of realised we obviously should have had nickel on this on sort of like both polls, but at our Minds and Money Asia show last week, when we polled the audience and we asked them to poll the commodity that they were the most bullish about, copper was in first place, followed by nickel, followed by gold. So it's interesting. We've got a very sort of like different sort of result today.
Yeah, I think the challenge with nickel is that when you look at lithium or when you look at cobalt, I mean, these are battery stories. Okay, the battery is going to significantly drive demand for those two metals going forward. Nickel and honestly copper to a somewhat lesser extent, they're obviously much larger markets, and so it's going to take a lot more demand to really move the needle for those metals the same way that it has for cobalt and lithium. And so that's why I'm a little bit more muted, or maybe less optimistic on the nickel side. I just don't see the EV push, or whatever you want to call it, really driving nickel demand going forward.
Okay, thank you very much for that. I think that now brings us to the close of our webinar. So I'd just like to thank Chris Berry, President of House Mountain Partners, John Hykawy, President of Stormcrow Capital, Jack Lifton, Founding Principal of Technology Metals Research, and Carlos Vicens, Chief Financial Officer of NeoLithium. Chris, John, Jack, and Carlos will also be speaking at our upcoming Minds and Money New York show. Our Minds and Money New York show takes place on the 1st and 2nd of May at the Rockefeller Center in New York, of course. There is a special webinar offer for those that have tuned in today, registered by Friday the 12th of April with the code MMNYC10W to claim a 10% discount. And also for those people who want to go and, for those listeners who want to go and listen to more of our webinars or listen to more of our content, please go to our 365-day constant news website, which is Mining Beacon, which is miningbeacon.com. And there you'll find other interviews and other webinars and other videos of our presentations online for you to go and read and view at your pleasure. My name is Andrew Thake, Head of Content for Minds and Money. I hope that you enjoyed this webinar and look forward to seeing you at our next webinar. Thank you very much.